Appreciate everyone taking the time to join us this afternoon. So let's take a look at just a quick agenda. This is just a brief listing of some of the highlights we'll hit today. So let's get started. Taking a look at both the economic picture first, because that does inform the way we view, in some way, the 2023 second half outlook. And some of these slides should be, again, pretty familiar to previous viewers, but I think it's worth showing this one in particular because this is, in my opinion, one of the best, most broad pictures of the overall health and direction of the two major components of the economy. In the purple line, you have the services sector, and in the orange line, you have the manufacturing sector. The dashed line, just for orientation purposes, is 50, and in this time series, any number above 50 means that part of the economy is in expansion. Any number below 50 means that part of the economy is in contraction. And just some things to point out here, of course, maybe in concert or sympathy with the inversion of the yield curve last year, you'll notice that the manufacturing sector here in orange has been in a pretty decent decline ever since late last year, really kind of helping us inform our opinions that, bond market may certainly have some interesting dynamics attached to it. Certainly that's started to play out this year. But more importantly, the services sector, which comprises, by some estimates, roughly 70% of the U.S. economy or output, is still very much in expansion territory. And you see that expansion showing up in, tight labor market, strong GDP numbers that are still, really nicely positive so far. So it has a lot of people kind of questioning, where's the recession and when's it going to show up? We'll certainly touch on that in a moment, but I think the broadest picture of the economy is still suggesting we're kind of bouncing along in a stable, maybe slightly increasing position with the U.S. economy. And from that perspective, things don't look so bad. I will say one of the things that we are paying very close attention to, and this is something that I will explain, is the yield curve. So, and there's various ways to look at it, but essentially what we're looking at here is the difference in the 10-year bond yield versus or minus the 3-year bond yield. So, just by way of reference, any number above 0 means that the 10-year bond is yielding higher than the 3-month bond. Any number below 0 means that the 3-month bond is yielding higher than the 10-year. And why do we pay attention to this? Well, it has a uncanny and remarkable track record at predicting recessions. This is the famous inverted yield curve. But what I think is more important, and as kind of the arrows suggest here, is we're not necessarily waiting for the yield curve to invert. I think we've been very clear about that. That yes, it's an inverted yield curve is a signal that a recession is out there. But I think the more important signal to pay attention to is when this line starts to go back towards 0, or in this case, goes back towards 0. They call that a re-steepening of the yield curve. Because why would that be? Well, generally, and you can see it even had a pretty remarkable predictive power back in 2020. I'm not sure how that happened. But if you look at, 2007, and into 2008 is when the curve here started to reinvert or to steepen. This was a little late of a signal, but it was basically in 2001-2 timeframe, so a little bit of a late warning signal there. But 1990, the re-steepening occurred in advance of the recession that occurred in 1990 for the Gulf War. Same thing with the 1980 recession, and then all throughout the 70s. So why is it important to look at? Well, it's because, generally, I think the bond market is looking past the recession and towards a brighter future. And if there's a brighter future, that generally comes with higher economic growth and productivity and output. And theoretically, higher bond yields should be a consequence of positive growth and accelerating growth. So what are we seeing now? We actually are starting to see the first semblances of this number or this line going back towards the positive. So we're definitely on alert here. And this is probably, I would say, our most important indicator we're looking at right now to see how this number will evolve over the next months, few weeks and months. Going back to one of our charts that I showed many years ago, or not many years, early last year, because a lot of people were getting concerned about inflation. Obviously, but that was a concern of ours. And the contention, according to some data, which I'll show you in just a second, is that once the rolling 12, this is the month over month CPI progression, so an annualized rate month over month, and this is the rolling 12-month average. And this rolling 12-month average of inflation actually had us crossing 6% and going lower at the end of July. So this is a pretty fresh reading. And why does this number matter? Well, the next slide shows you exactly why. It's because when you're at a high level of inflation of 6% or higher, stock and bond markets tend to generate negative returns over that time series. This is over a rolling 12-month average. However, when you go from a higher number down to lower numbers, so between 4 and 6, then on average, this is from 1970 through 1921 or 2021, numbers get much more positive. And you can see, I think the punchline here is that markets just don't like outlier numbers. So below zero for rolling 12-month inflation. So think Depression era for 1920s type situation, or when both, we've got high inflation above 6, that the market just does not like outlier numbers. So when you get into what's, I guess, maybe the Goldilocks zone down here, or just a little bit above that, that your return numbers going forward tend to be much more positive. Now, I would say one caveat to this is that it does appear that the S&P has probably front run this move from a higher inflation number down to a lower one, because 2021's performance, I think, would suggest that some of this performance potential has already been pulled forward. Bonds, we haven't really seen that yet because it's been a very choppy and in some cases negative bond market for certain parts. So still on watch to see how this inflation is going to evolve. Our takeaway is as well, rather than waiting for the S&P to generate 8.6% now that we're below 6%, we're actually looking at sectors or parts of the market that didn't necessarily participate year to date in this rally to see where there might be opportunity shifts. So thinking things like real estate investment trusts or energy markets or healthcare market. Health been a spectacular day today based on 2 really strong earnings reports from Eli Lilly and Novo Nordisk. So these are areas that we've been looking at, certainly mindful that they've underperformed in areas that we find very interesting right now. Portfolio themes for the second half of 23. So some of these have changed, some of these have stayed the same. Maybe we'll focus on the ones that have changed. And I would say, similar to our kind of ideas from last Market Matters, is that commodities definitely appear to be on a much stronger footing with a weaker first half of the year. So whether it's across energy, metals, or the food and agricultural complex, commodities are all finding a pretty strong footing in today's market. And I think this is also consistent with late cycle activity, where commodities tend to move upward in price as inflation or labor demand pulls those prices higher. As more people get pulled into the workforce, there's just more demand for those things. And that's certainly happening now, particularly in energy. You can see it with crude now having bottomed out at 68 2 months ago, is now well above 80 at the moment. And then the other one that's changed here is don't fight the Fed. I think it's definitely a battleground right now in short-term markets for bonds, where you've got expectations being very different in where longer-term rates are going to land. Our approach to this point has been, well, let's just take a more neutral or defensive approach in interest rates. So staying very short-term in bonds, basically playing it safe in the short end, because right now we're being compensated to do so. And anyone buying long-term bonds right here, I think, is going to be upset with their return if we have budgetary issues later in the year into 24. Investment ratings, just a few things, and I'm trying to do a better job of kind of highlighting or pointing out what we're changing and maybe what's remaining the same. So the only thing that's really changed from the last time we did this was an upgrade to municipal bonds. That's, of course, short to intermediate term municipal bonds. Those have recently migrated out of kind of a neutral stance into a little bit more attractive stance. Part of the reason of that is because some states, Washington notably, but also California, are all batting around increases to their state income tax, whether it's through capital gains tax increases or just straight up state income taxes. So I think munis are getting incrementally more attractive. Plus, the supply demand right now in municipal bonds is much more attractive as an investor versus what's in front of us on the federal on the federal side and corporate side, where corporates need to refinance after COVID level low interest rates. They're now having to roll over some of their debt maturities at much higher rates. And then, of course, the T-bill issuance out of the U.S. government is set to be exceptionally robust here in the next few months. So definitely wanted to just point out, though, that we still have a preference for short-term U.S. government and agency bonds like Fannie, Freddie, Ginnie Mae, Federal Farm Credit Bureau. Those are all really attractive credits right now, and muni bonds are attractive as well. Just taking a quick peek at where we are with the company earnings picture update, because we are now midway through, maybe a little bit more than midway through the earnings season. And I think maybe the takeaway from this picture is that for Q2 earnings, and this is earnings that occurred in the past, of course, but the bar was set pretty low because analysts had expected the S&P to have earnings decline of 7% coming into the quarter. What's actually happened is that earnings have only declined 5.2%. A big part of that benefit has come from information technology. You can see, whereas analysts had expected earnings to be down, they're actually posting positive numbers. And surprisingly, in things like consumer staples, whether it's Mars or Procter and Gamble or Clorox, are all indicating strong demand for products, but also pricing power as inflation is now allowing them to raise prices. And of course, industrials and consumer discretionary. Amazon is the largest company in the consumer discretionary sector, had a blowout quarter. It's a little bit of a hard comparison because they have everything from data center to video production to video games, but nonetheless, a big earnings beat, and that's certainly, I think, a catalyst for why the S&P is trading where it currently trades at the moment. And that leads us to maybe some positioning. Certainly now is probably not a bad time to be looking at making any sort of adjustments on the equity side. We have done a few tweaks around the edges, but nothing too substantial quite yet. You can see, basically what's happened through yesterday is that the growth segment, a large cap growth segment of the market through yesterday was up 29.9%, call it 30%. S&P has come off its highs a little bit, up 17.8%, and value sector is only up 6.7%. So, the idea here would be, let's look at areas that haven't really performed as well. So maybe some of the more value-oriented sectors, look at those as a focus for new capital and shifts, and take any action when the time or opportunity presents itself. I did want to revisit our REIT, kind of thesis here. And the idea was that, REITs were a massive overhang from 2022 and into early 2023. This is what I'm calling the Gratus Office REITs Index. It's just the top 7 REITs we put together in a equal weighted basket, just to give a loose proxy of what office REITs are doing. And you can see we called out this idea that they may be a little oversold, and that was leading us to a positive view on the overall REIT sector in this orange line at around that time. And you can see they're up roughly 30% since that time. We didn't buy any office REITs. I just wanted to point out that we were starting to find REITs attractive at around this time. Made a little bit of money on REITs so far, but we think that even with interest rates having risen the way they have, office REITs now are discounting pretty negative scenarios in the future, in that we've either added to or we'll be looking to add additional names on the REIT side as opportunities present themselves. Turning to the bond market, this is an area, again, that we think kind of the financial worlds are revolving around right now, because we haven't had as much volatility in the bond markets as we have in, call it, 40 years or so, since the early 80s. And this is just a picture of the 10-year bond yield going back, call it, I guess it's 10 years now, back to 2013, and showing you the yield progression. So obviously we're at the highest level in the 10-year bond. This is the 10-year bond yield rate going back 10 years. So the highest level since that time, actually since probably the early 2000s. And I just wanted to point out that, this is some pretty, meaningful activity here in the 10-year bond, because after peaking out mid to late last year at about 4.45 on the 10-year bond, coming off that level pretty dramatically. We are now getting very close again to those levels. And if we bust through this 4.5 level in the 10-year, it would be safe to, I think, assume for our process that yields would continue to move higher, because if we get through this upper level, it's going to be for reasons that aren't great. Either that inflation shows back up, or investors start to become concerned about budget deficits and issuance, or it's a currency issue or something along those lines. So I guess be mindful of your exposure on the duration side, because we have really not a lot of reason to look at long-term bonds in any of our portfolios for the foreseeable future until we get to a level that we believe is acceptable to take on that risk. And I know some clients like to ask, well, what's that level look like, or maybe what would be a good level to think about if we wanted to move out of things like maybe liquid alternatives or things of that nature. And I go back to, well, it's probably a number like 5% on the 2-year bond, which we aren't too far away from that. We're at about 4.4 or something. But that can change as inflation dynamics evolve and budgetary issues evolve. So that's our kind of loose framework right now. Let everyone know what we were thinking. Going back to this chart here, I showed it once before, but I do think it's worth pointing out that we still find ourselves here. This is the purple line is the CBOE VIX index, or the volatility index, and the orange line is the high yield bond spreads. So how much over treasuries are high yield bonds paying at the moment? So just take the treasury for this duration, which is I think is about 5 years, add 4 on top of that, and that's where you get your average high yield bond yield. And why do I show this? Well, I think what this is showing that there's quite a bit of complacency being baked into the market right now. Most complacency in certainly over a year, probably 2, because we've got a very low level of equity volatility right now, which in my opinion is not necessarily accounting for some of the challenging economic road ahead, but potentially, but also the bond market itself as well too is having a very low yield spread level in high yield bonds, meaning that you're not being compensated that much to take on high yield bond risk. And these two things together are not necessarily showing a rosy opportunity on the horizon. So we just want to make sure we're being mindful of the risks that we're taking and where we're positioning, because these two indicators are telling us that we should be a little cautious at the moment. Same with the inverted yield curve steepening. Again, another point on bonds is that, we've reduced our bond allocation. I believe it was 2 or 3 years ago. In a 60-40, we took a part of that bond portfolio and added it to liquid alternatives. Part of the reason was because yields got very low, but also the idea was that, I think it was right around this time, or maybe it was a little bit earlier, was that stocks and bonds were correlating positively. So for a diversified portfolio, what we're trying to do is put together assets or strategies that have low correlation with each other, because if they have low correlation with each other, that's just going to make the ride smoother. So just for a loose way of reference, what we're looking for in our bonds is that if stocks are down, bond prices would be up. And if stocks are up, then bond prices might be flat to slightly down. And so that's a negative correlation. Positive correlation means that if stocks are up, bonds are up, and if stocks are down, bonds are down. And in that case, your bonds are providing you very little diversification and benefit to ownership. So that's kind of the position we're taking right now, is that with such a high correlation in stocks and bonds right now, that utility for particularly longer term bonds is pretty low. So we continue to evaluate that on an ongoing basis. I did mention, in one of our bullet points, a lot of clients I understand are slightly uncomfortable with where market values are trading. Certainly valuations are a little on the higher side of our comfort level, no question about it. But that doesn't mean we shouldn't have exposure. And I think these are just kind of wanted to lay out kind of a loose playbook as to how we think about these things now that we're at nearing all-time highs. What's the playbook look like? So, I think the first part of this is to identify, what are the outliers right now, and then try to understand why these things are outliers. So, for example, why has growth done so much better than value companies, and what might change that? And so we have definitely some ideas on how that might shift or evolve over time. But I think certainly grabbing the outlier scenarios and try to understand why those are moving as a really important first step. Once we have that first step, though, looking at, all right, well, what's our repositioning and or rebalancing plan? Because when assets have very different returns over the same time period, that does give you unique opportunities to, trim back stuff that's done really well, add to stuff that you like fundamentally long term, and that small process over time has been very additive to not only our portfolios but just most portfolios hypothetically, because you're constantly trimming back some of the excesses in your portfolio and adding to more value-oriented positions, and that can be a really powerful portfolio management process. But you must follow through, of course. I think certainly a little caution is warranted when valuation levels get to where they are now, and when divergence in the market's been this great. So, our kind of counsel is, of course, don't get too aggressive when valuations are high, but you must have exposure. So this is one reason why, for us, and we've learned many lessons over the years, certainly some hard ones. Probably the 2009 lesson, I think, was you must maintain your equity exposure, because you could miss a ripping rally, and having no exposure, like if you're just sitting in cash the whole time, is really a bad place to be in, and that's going to just add to anxiety longer term. So, not being too aggressive, but maintain your exposure. So for most of our accounts, they will be right on top of their long-term equity target at this point in time at the moment. But underneath the surface, we'll be making some small changes that help us be a little better positioned for maybe what we see in the future, which is a potential drawdown or recessionary type conditions. And then, for those clients or people coming to us with just cash, or if you have cash sitting on the sidelines, I think one very helpful solution to just taking action would be to set up a dollar cost averaging plan, where it's very programmatic. It's not, and first day of the month or 15th day of the month, something along those lines, that forces you to engage in the behavior that's ultimately going to help your long-term financial planning goals and objectives, you achieving those. Just some takeaways, and certainly, by the way, just a reminder, if you have any questions, please drop these into the chat function. I would love to hear what's on everyone's mind. But just some takeaways. Certainly we continue to believe that this rally is very much so rooted in capital flows right now, not necessarily fundamentals, because of how disparate the move has been. It's discounting a lot of really good economic activity that hasn't quite happened yet. So, but I think that the net is that some cracks are starting to emerge. Global stock markets are, right now at least, and starting in August, taking a little bit of a breather as earnings reports are digested. And we're still going to maintain our U.S. large cap and some mid cap exposure bias and equities right now. It's not a great time now is a great time to be managing risk where appropriate. So again, just that simple blocking and tackling of trimming off maybe a couple of positions, not selling completely, but trimming off some large cap technology holdings down to a more neutral weight, because those, of course, have the most elevated valuations. We've been doing that in our portfolios as well. And it's an excellent time to add back to positions that necessarily haven't worked or maybe been left behind. So again, things like healthcare, or even some industrials or materials, energy companies, are all areas that we have an interest in at the moment. Still have a preference right now for alternative strategies over bonds, just because of that correlation dynamic right now. And we haven't quite achieved yield levels that we'd like to see to shift back to bonds in a more meaningful way. That's why we still have a preference for alternatives, and particularly private markets, I think, still add a lot of optionality and opportunity right now. And then the final piece I would just mention is, all-time highs are never comfortable if you're looking for a good deal or have a value orientation. I certainly have had to fight some of the instincts I have constantly about, trying to buy $1 for 15 cents type thing, the Warren Buffett cigar butt approach. But I think the most important thing to have right now is a plan and sticking to it, but also trusting in the process, because what we know And there's a great slide deck I could certainly send around to anybody that wants it. And it's called our Evergreen Investing Concept slide deck. But what we know for almost an absolute certainty is that the longer time you have in the market, the higher chances of success you have at capturing that market return for equities in particular. Bonds, I would say, are a little less certain given time and currency fluctuations, but equities in particular, it doesn't matter which equity market you're looking at globally, the longer time you have, there's an equity risk premium that is there, and we just have to stick it out to benefit from that. I definitely wanted to thank everybody for joining. We look forward to speaking to you again sometime soon. Thank you.